Money FM 89.3. Best of breakfast. The Bigger Picture, only on Money FM 89.3.
Welcome to The Bigger Picture. I'm Dan Koh. Now, after a year of volatility, Singapore REITs are finally finding their footing. Morningstar's latest report shows a market in recovery, with office and industrial REITs leading the charge, retail holding its ground, and investors rethinking where the value still lies. But not all REITs are created equal. After all, some are still struggling to catch up, and the next phase of recovery may not be as straightforward. So to unpack the latest trends and what they mean for investors, I'm happy to invite on the show Xavier Lee, the equity analyst at Morningstar. Good morning, Xavier. How are you doing today?
Hi, good morning. Thanks for having me here.
I'm so glad to have you on with us to talk about S-REITs. So let's take a deep dive into Morningstar's Q3 2025 report on Singapore REITs and how the sector's faring after months of volatility. So interestingly, your report highlighted that Singapore REIT index rose about 21.5% year to date as of September, which also makes it one of the best runs in recent years. So what's been powering this rebound? Is it primarily rate cuts and yield compression, or is there like a genuine demand recovery underneath the story?
Yeah, it's been a very strong performance indeed. The Morningstar Singapore REIT index was up about 10% this quarter. So this is a very powerful recovery, and I think it really signals a clear shift in investor sentiment.
Yeah.
I would say the strong performance is primarily rates driven, with the market expecting further rate cuts in the future.
Yep.
So here at home, our local benchmark SORA has already dropped significantly from a high of 3.1% in January and to just about 1% yesterday when I last checked. So, REITs are leveraged assets. Falling interest rates mean lower borrowing costs and higher distributable income.
Yep.
So this gives them also a much attractive yield spread versus the current risk-free rates. That said, I think we have strong fundamental support for the underlying real estate sector, particularly in segments like suburban retail, data centers and offices. These are sectors that have continued to report positive rental reversions.
Fantastic. We'll dive a little bit deeper into the subsectors in just a bit. But what's interesting is that, even after such a strong rebound, S-REITs are still trailing the broader Asia equity market over the past year. So it does suggest that, part of it is structural, slower earnings momentum, high funding costs, and investors rotating into growth and tech names. So why else do you think the sector continues to lag the broader market despite the rally? And is it just the nature of REITs just being defensive, would you say?
I'll say that the lag is really due to the Singapore index, the broader index being heavily driven by, stronger performances of DBS, Singtel, Singapore Exchange, and ST Engineering. DBS has a disproportionately large weight in the STI index and has done extremely well this year to date.
Yes, we just talked about, how it's recently hit its all-time highs and, of course, a market capitalization of $150 billion. So kudos to DBS right there. But let's take this conversation back to S-REITs and where we're seeing, the report noting that, the sector of S-REITs still trades at a roughly 17% discount to book value with an average price to fair value ratio of around 0.96. So it's not as deep of a discount as we saw in 2024, but still quite below historical norms. So how are you reading this, Xavier? I mean, are valuations now fairly reflecting fundamentals, or are there still room for upside as rates ease further?
I believe valuations still remain attractive in our view. REITs are trading, as mentioned, REITs are trading at a 17% discount to the book value. Office REITs are actually at the steepest, at about almost 43% discount to the book value.
Wow.
I think investors need to be selective, and within our coverage, we think that Keppel REIT, Fraser's Logistics Commercial Trust, Mapletree Logistics Trust, and Mapletree Industrial Trust, we think that these four REITs still continue to screen as undervalued.
Fantastic. All right, thanks a lot for that, Xavier. Now, Morningstar also highlighted that despite cap rates, the risk of asset valuation remains low. So it doesn't seem like a bubble scenario, but more of like a steady income with selected value as of now. And it does paint a pretty varied picture across sectors, from office to retail and industrial. So when you look across the three segments, or just, S-REITs in general, which one really stood out this year? And which still faces the steepest headwinds as of today?
Yeah. Relative to each other, the office REITs have had the best performance this year. Meanwhile, industrial REITs have underperformed. We think that office REITs have done well because the occupancy rates have remained strong, and most of the REITs have reported strong rental reversions. In the CBD, the office vacancy rates are also tightening up as the IOI Central Boulevard gets filled up. There are no major office supply in the CBD in the next 3 years, so I believe we'll see an acceleration in rental growth over the next 2 years. So industrial REITs have obviously underperformed because of all the uncertainty regarding the tariffs. So they are struggling a little bit, but I believe that take-up has still been healthy despite the uncertainty. So they are lagging a little bit, but that's also why we see them as being undervalued right now.
Oh, fantastic. It's great to hear that at least there's some value to be seen with S-REITs, as long as we selectively choose and pick which of the sectors might be able to benefit from this environment. Now, none of this happens in isolation. After all, the Fed September rate cut, what you've discussed earlier, and expectations of another move this month would certainly help sentiment within the real estate space. But we're also seeing new uncertainties from the likes of the US government shutdown, and that is also delaying key economic data, and inflation still remains sticky as of now. So how sensitive are S-REIT valuations, would you say, today to further moves in the US? And beyond interest rate policies, what other global factors do you see affecting price movements here in Singapore?
Yeah, definitely. I think, if there's a resurgence of this sticky inflation, central banks may keep rates elevated. This will derail the market's anticipation of rate cuts. So I think that would be the key driver in affecting REIT prices.
All right. Thanks for that, Xavier. Now then, can we dive a little bit deeper into Morningstar's top picks for, specific stocks? I know you mentioned Capital earlier today, so maybe dive a little bit deeper into, what makes it an investment case for you at Morningstar today.
Yeah, so our topic is Capital REIT. We like it for its portfolio of high-quality office assets in Singapore, Australia, South Korea and Japan. Their tenant base is really one of the best in class. They have government agencies, international banks in its tenant register. We also think that it's well positioned to benefit from a strong growth in office rents when excess vacancies get absorbed and vacancy rate tightens. So, for the reasons I've explained earlier about the office outlook, we think that Capital REIT is one of the best positioned to benefit from this trend.
All right, that's a great breakdown of what's to be expected. So, looking ahead, Xavier, how should we be positioning our portfolios if we're looking at including some S-REITs into our investment portfolios today then?
Yeah, REITs are good for investors looking for dividend income, right? There's stability because leases are signed for 3 to 5 years. So this gives them a very steady cash flow for the REITs. At the same time, there's also the growth angle, as Singapore real estate market is fundamentally still very resilient. Market rents are also growing across most sectors. So interest rate cuts will be a tailwind for DPU growth, and REITs will enjoy lower borrowing costs, and I actually expect them to find more inorganic growth opportunities through M&A. Yeah.
Fantastic. Well, if you're looking for any other investments outside of tech plays and AI, which has been playing out for much of this year's investment theme, well, S-REITs might be a space that you might want to look at. Meanwhile, thank you so much for breaking down Morningstar's latest report with us, Xavier.
Thank you.
All right, we've been speaking to Xavier Lee, the equity analyst at Morningstar, talking all about S-REITs and what to be expected in the foreseeable future. Keep it right here with us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
Money FM